So firstly, good morning and welcome to our professional services webinar on the economy, new fiscal environment and way of working. We've been through clearly the most bizarre period, both socially and in our business lives over the last few months, and often reflect on where we might be if we hadn't got technology. Certainly not having the same level of connection with our families and businesses, and keeping our own businesses running at the current time. We've generally seen in professional services businesses being fantastic at reinventing themselves in times of crisis. Firms have acted, shown decisiveness and resilience through the last few months, and now are reflecting on how to adapt themselves to the future and what is potentially a very different world going forwards. In terms of the economy, seems to be a constant stream of less than positive news. A weak recovery in May, consumer spending still down, daily news of job cuts in the most affected sectors. And clearly, as we look to the future, not only have we got C-19 to contend with, but we still have Brexit on the horizon, and continuing tensions between the US and China. And rather randomly was reading something on the internet last night that was telling me about the Spanish flu 100 years ago, where the last case was actually reported, I think, in the 1950s. So let's hope we're not in for as long a period this time. With that outlook, I think if we could turn to the next slide, I'd like to introduce this morning's speakers. So we have delighted to be joined by Chris Hare from HSBC Global Banking and Markets. Chris has previously also worked at the Bank of England and a number of other very reputable institutions, so has some fantastic insights, and really pleased that Chris is joining us here to share his thoughts on where things have been and where we might be going. And also joined by BDO's very own Peter Hemington, and also Colin Ives, Senior Tax Partner in our Professional Services team. If we turn to the next slide, much of our thinking at BDO is centered around our rethink model. So those of you who have dialed into previous webinars will have seen this. It's our global model drawing on all aspects really of our expertise to help us and also our clients think about the crisis in context, shorter and longer term, and how we start to respond to that. So do look it up. We're very happy to engage in conversations around this if it's helpful for you and your business. We've posed a number of questions to our panel. So here on the right, looking firstly at a global and a UK perspective. So starting wide and thinking about exploring some of the economic forecasts, thinking a bit about the outcome of some of the government stimulus that's recently been announced, and then longer term trends in terms of work practices in a post-COVID world. So lots of points of interest. In terms of the format, if I could just request that everyone keeps their cameras off, that would just help us to facilitate things. We'll keep this very much to an hour, and we are recording the session to make available to you afterwards. We'll hold a good slot for Q&A. We've already had a number of questions through actually, but do encourage people to use the chat facility within Teams, which is on your control panel. You can see the little show conversation box. If you click on that, then you should be able to type in there, but do be aware that whatever you put in there should be visible to everyone. And do, of course, if we get into Q&A and want to ask a question, do feel free to unmute yourself and to ask a question directly to any of our panel. So without further ado, I'll hand over to Chris for some perspectives. And I'm sure, Chris, you're geared up to cheer us all up on a slightly wet morning.
It's a bit of a grey day and a pretty gloomy set of economic forecasts, I'm afraid. So I'm not sure if there's too much sunshine I can bring. Maybe a couple of silver linings here and there. So I'll see what I can do. By way of introductory comments, there are really three things I wanted to talk about. First, a bit of an overview of how we at HSBC see the global economic outlook in the context of COVID-19, of course. We're calling it the not so grand reopening of the global economy. Second, I want to talk about the UK, where those global themes very much apply, but there's some interesting stuff, as you've already touched on, to talk about with regards fiscal policy and Brexit. And third, a little bit of future gazing and some of the kind of things that we've been thinking about with regards to what the post-COVID-19 world might look like in terms of the way we live and work and some of the economic implications of that. So let me start with the global overview and that not so grand reopening of the world economy. Now, economies around the world, when we're looking at Asia, Europe, even most of the Americas, have been gradually reopening their doors. Now, that's something certainly that we see and feel in the UK. Now, some of the economic data have actually improved relatively well. That's sort of inevitable as you turn a switch off in terms of the global economy, as you start switching it back on again, some of that activity is going to come back. Evidence of that, well, we had annual GDP growth numbers from China this morning, where after in the first quarter, we saw a year-on-year contraction in economic growth of 6.8%, but in the second quarter, an expansion of 3.2%. And that would imply that the level of economic activity in China is actually above where it was pre-crisis, although still substantially below where it would otherwise have been. Elsewhere, business surveys have stabilized, and actually some of the monthly data are looking pretty good in some places. If we look at continental Europe, for example, if I were to point you in the direction of German retail sales or French car registrations, they're also above pre-crisis levels. So a little bit of good news there in terms of the initial recovery. But there's so many reasons to be very cautious about getting too excited about all of this. Inevitably, as I mentioned, you're going to get some bounce back in activity as you switch bits of the economy back on, which were completely switched off through March and April. But we're very concerned about broader lingering effects relating to COVID-19, some of which haven't really come through yet. So that after the initial bounce, we think the world economy is still likely to remain very much below where it would otherwise have been in the absence of the crisis. So what are the kind of lingering effects we're thinking about? Well, one obvious one is fear, caution on the part of consumers and businesses. Understandably, consumers are likely to be cautious about engaging in economic activity that will bring you in close contact with other people. Businesses, we think, are unlikely to want to invest to expand capacity. Where they are investing, often they're having to invest in social distancing measures, but those are the sorts of things that imply impairments to business capacity. If you think about spaces between tables in restaurants, for example, simple examples like that. Meanwhile, the fallout in the labour market, I think, is only just beginning. People are being laid off. We see those news reports in the UK, for example. Now, most economies in Europe have wage subsidy schemes, which means that the job market is being supported in a lot of places around the world. But those schemes can't last forever. A lot of them are going to be tapered. The UK is no exception here. So in our view, unemployment rates are going to rise pretty substantially in a lot of economies around the world from here. And in terms of that, an extra lingering effect is the legacy of debt. Now, a lot of businesses have been having to tap emergency finance in order to keep going through the crisis. Governments have had to borrow very heavily indeed, and at some point in the near term for businesses, in the longer term, I think the government, some retrenchment is going to be needed further down the line. That's likely to be a headwind to the recovery from our point of view. Now, in case you're worried that I'm not being gloomy enough, well, there's even that question to be raised as to why some economies are reopening at all. If you look at the very grim statistics of COVID-19, we're looking at about 13.5 million cases worldwide, 585,000 deaths from the disease. That's from Johns Hopkins University. Now, at a global level, the COVID-19 caseload isn't just rising, but it's actually accelerating. And in some of the countries that are looking most grim, parts of the US, although there's been maybe some stabilization in the last few days, Brazil is a very bad case, and indeed lots of Latin America, Mexico is another example, India, Russia, those are the kind of economies that we are concerned about. And there's a risk here, of course, that more stringent lockdowns will have to be reimposed. Indeed, we're seeing that in parts of some of these economies. So beyond those lingering effects, of course, there's that risk, but something we're actually seeing of the reimposition of lockdowns, which of course is going to be a big headwind to economic activity. Now, through all of this, an important saving grace from my perspective is that relative to the financial crisis, I would argue that policy has stepped in a lot more aggressively, or I think more successfully, to be honest. On the fiscal side, we've had those job support schemes, as I mentioned. At an EU level, we're seeing a big recovery fund being negotiated worth 750 billion euros. There are risks about it being implemented, but this is something that's much bigger than we would have expected before the crisis. And meanwhile, central banks have managed successfully to keep credit flowing generally. They've managed to keep interest rates faced by households and businesses low, much lower than they were after the financial crisis last time around. So monetary policy has been very loose, and I think that's likely to be the case. Policy is likely to stay very stimulative in order to try to support that recovery over the coming years. But of course, policy can't cure all ills. We're also going to need epidemiological improvements, the private sector to come back online to start bringing economies back to those pre-crisis levels. So it's a hard slog, to be honest. Turning to the UK, a lot of those themes sort of hold. I think I should start my points on the UK with the point, Andrew, that you mentioned. The recovery in the UK is not looking so encouraging as those German retail sales numbers or those China GDP numbers, for example. We had a 20% decline in output in April in the UK economy. It's unsurprising, the economy was locked down. Then we had a 1.8% expansion in May, and that's well below what we and other economists were expecting. Now, you could put an optimistic spin on that and say, well, the UK economy was locked down a little bit longer than other European economies, so the bounce back is just around the corner. But it's a downside. It's a downside piece of news. It's potentially a risk here that those lingering effects are really kind of rearing their head in the UK for one reason or another, and it's a bit of a downside risk to our forecast for the UK. Now, in response to these GDP numbers, Chancellor Rishi Sunak said that that really underscores the challenge facing the UK economy. Couldn't agree more. And consistent with facing that challenge, of course, the government has stepped in a major way in terms of fiscal policy. It certainly did that in March with the job retention scheme. Right now, of course, furloughed employees or temporarily laid off employees are getting 80% of their wages financed by the government. Employers, at least for the moment, aren't having to pay a penny, but that's soon to change with the tapering of the scheme over the coming months, and it's set to end entirely by November. Now, last week, further fiscal measures were announced. One of those, for example, was the job retention bonus scheme, subsidies for employers bringing their workers back from furlough and into work. But from our perspective, those grants are very small. I think they're a very small incentive relative to the scale of the tapering of the job retention scheme. So that labour market fallout, is a big risk to our UK view. Right now, we've seen this morning, there's a lot of data funnies going on, but the unemployment rate in the UK is still very low. The headline unemployment rate is still below 4%. But we expect it to rise pretty substantially, up above 7%. And I think there are upside risks to that. And if those upside risks materialize, it might be that the government has to revisit some of these job support measures come the budget this autumn. Now, while some of these fiscal measures are tapering, or at least the job retention scheme is tapering, monetary policy is still very accommodative. Bank of England's cut rates to 0.1%. There's been a whole swathe of extra QE announced. From our perspective, from all those worrying signs I mentioned about the UK, lingering effects, the pace of the recovery, actually, some of those data haven't been as bad as the very pessimistic assumptions that the Bank of England published in its last monetary policy report in May. From our perspective, we don't think the bank is going to do any more stimulus from here, but I think it's quite unsurprising given the weak outlook, which also means a weak inflation outlook. In the words of Andrew Bailey, policy options are going to be under review, and that includes the prospect of more quantitative easing, potentially even bank rate below zero. So those are the kind of issues that we're watching very closely from the Bank of England side of things. And finally, there's that downside risk with regard to Brexit. I've managed to avoid the B word quite a lot when talking about the UK recently, but it's sort of coming back on the table. We know the UK has effectively ruled out an extension of the post-Brexit transition period. To the extent that that line holds, well, where are talks going to lead? Now, from our perspective, if we think there's not going to be an extension, there are three different options. One is that ultimately the UK and the EU agree on a fully comprehensive trade agreement, including goods, services, regulatory alignment, so on and so forth. The second option could be a partial trade deal, zero tariffs, zero quotas on goods trade, but still quite a lot to sort out on services. And the third option would be a so-called no trade deal Brexit. So this is sort of a kind of hard Brexit type scenario. Now, by revealed preference so far in negotiations, both the UK and the EU have shown an ability to shift somewhat creatively in order to avoid disorderly Brexit outcomes. It's not our central case that we're going to get something disruptive at the end of this year, or too disruptive and disorderly at the end of this year. We think the most realistic outcome in the time available is a sort of holding position partial trade deal. Zero tariffs, zero quotas on goods trade, but still plenty of negotiations further ahead. Now, one of the sticking points, of course, in the negotiations is the UK's regulatory alignment with EU level playing field rules, labour market, social conditions, and things like that. We may see a scenario where the UK ultimately will be allowed to diverge from those rules. But to the extent that it does, the EU might turn around and say, OK, fine, you can diverge from those rules, but in response, we're going to impose a tariff. So you might see that even though this is a kind of arrangement that can unlock a trade deal, you might see that kind of dynamic disagreement between the UK and the EU lasting in perpetuity. So plenty of uncertainties ahead in terms of that trading relationship. Finally, a couple of quick thoughts on the UK and even the world, post-COVID-19 in terms of living and working and some of the research that we've been putting together on this. And the big theme from our perspective is the shift away from working in offices towards working in homes, a shift of economic activity away from city centres. What are the broader economic ramifications of all of this? We know it's very clear working from home has increased dramatically through the lockdown. From an HSBC perspective, I mean, this isn't the official line, but I don't think I'm going to be in the office anytime soon. And we think that those behavioural changes are going to shift in the longer term as people and businesses have discovered some of the virtues of working from home. So we've looked at one survey from the US, for example, from Gartner Research that suggests that 3/4 of companies are keen to shift towards more remote working going forward. And that has several implications. One is less demand for high density urban office space. There could be implications for the housing market. Already we're seeing evidence in a lot of the surveys of surveyors and potential home buyers of people more keen to live in bigger houses with more outdoor space from which they can work from home more. That could lead to house prices underperforming in urban areas, particularly in London, people thinking about accepting longer commutes to work. We don't think it's the death of cities. We think that people generally will want to keep in touching distance of cities or may want to live in smaller cities. So we're thinking about this more in terms of a process of suburbanization rather than deurbanization. But for capital city dominated countries like the UK, that could easily see more of a rebalancing in terms of economic activity. And I should mention that, despite the COVID-19 crisis, not all of that is necessarily all that unhealthy a thing to see in future. So just to recap very quickly on what I've said, the global economy is seeing some signs of recovery. There are some silver linings here and there, something sort of V-shaped looking in the very near term. But after that initial bounce, the process of recovery is going to be a really long slog. That's certainly also the case for the UK, and we are concerned about some of those labour market risks and, of course, about Brexit negotiations over the coming months. But maybe there's a story of optimism in terms of that story of suburbanisation, about living and working in a slightly more human way. So I'll leave my comments there.
Thank you, Chris. Really interesting insights, and you particularly reflect on that, thinking, well, with all of that turmoil, there's got to be some great opportunities for professional services firms to advise our clients, but clearly the key challenge will be whether we can charge for some of that advice. So I'll pass on now to Peter Hemington from BDO.
Thank you, Andrew. So look, I'm basing a lot of this session on some work that we commissioned from the Centre for Economics and Business Research. And this is an organisation, it's an economic forecasting agency that we work with for many years. In fact, I've worked with them for the last 20 years or so, and I front a survey that we do with CBR called the BDO Business Trends, which is a kind of survey of surveys. It's a sort of meta survey of all the surveys of business confidence that are out there. And we thought it'd be interesting to look at some different scenarios in terms of how this crisis is likely to develop. But first, just painting the picture as to what the crisis looks like at the moment. You'll have seen some figures from the OBR yesterday, which took a lot of publicity. Potentially, we're going to see a 35% plunge in output in Q2. We're going to see a government deficit of 14% of GDP, which is the largest since World War II in any single year. I think the biggest year in the GFC was something like 10%, which presumably was 2009, 2000 or 2010. We're going to see government borrowing of 278 billion, strangely precise figure, and that to a significant extent is driven not only by the increase in government spending and the measures that the Chancellor has taken, but also a collapse in tax revenues of about 130 billion on 2019. So, you know, you can see a big chunk of that increase in spending is about actually a decline in economic activity, leading to increased government borrowing. The government spending is going to be 90 billion higher than they were thinking that they were going to spend in March. So these are very, very significant numbers. The hardest hit sectors are education, which is down 90%, perhaps unsurprisingly, but perhaps equally unsurprisingly, but more importantly, accommodation, food. Education, you know, is largely a state-provided service. Accommodation and food is an integral part of the economy. And I should say that as well as fronting some of BDO's economic stuff, I'm an M&A partner who specialises in leisure. And leisure, you know, has been in a consumer recession, or the consumer economy, that part of it, which is accounted for by leisure, has been in recession pretty much since the beginning of 2019. But we didn't expect to see anything like what we've seen in 2020. And you know, we've seen a lot of government intervention, the latest of which was last week, which was the latest mini budget, as we used to call them in the 1970s. That's a phrase that hasn't come back yet, but maybe we'll see it back. So allegedly 30 billion of spending. The government likes to dress up the numbers, as we know. We've seen a stamp duty, major changes in stamp duty. We've seen a big change in hospitality VAT, cut to 5% until the 12th of January 2021. And that's been very interesting to watch as someone who's a practitioner of M&A in the hospitality sector. The sector is really wrestling with itself as to what it should do with that cut. Should it pass it on to its customers, or should it, and this is a sector that has been really battered around by this particular crisis, should it hang on to the money, keep prices the same, and try and rebuild both profitability and balance sheet strength? We also saw the end of furlough bonus, which will be interesting to see whether that works. And I think the Permanent Secretary of the Treasury decided that wasn't good value for money, and various other measures. But I think a lot of commentators seem to think that the Chancellor was actually keeping his powder dry in case he needs to do something rather more substantial. So what we did is we thought it was so difficult to see how this crisis might play out that we'd ask our friends at CBR to look through a few different scenarios. And the baseline scenario was to say that you know, the pandemic progresses as we expect. So you start to see businesses being allowed to reopen by the end of July, and indeed we're seeing that. I think BDO is starting very gradually, for instance, to open its offices in early August. No second wave, no general lockdown. quite a lot of social distancing, quite a lot of working from home continuing. No extension of the coronavirus job retention scheme, and a gradual rise in employment over the summer. Although we've seen some figures this morning, I don't know whether people have seen that unemployment has actually slightly decreased on one measure in the latest set of numbers, which is clearly a result of the job retention scheme, but an interesting fact that we're seeing at the moment. We also thought we'd look at a couple of other scenarios. An upside scenario representing a more optimistic view on the progress of the pandemic, and essentially that the virus is contained very quickly, and that actually the first quarter of next year, 2021, feels rather like the first quarter of this year. It's interesting to see that there's been quite a splurge of publicity about one of the ways in which the life sciences community is responding to this, and it does appear that there are encouraging noises about a vaccine. We'll see if that happens, but I don't think too many of us think that the first quarter of 2021 is particularly likely to look like the first quarter of 2020. The downside scenario that we asked them to look at was really based around a second wave and what the impact of that might be, and particularly the way in which the economy might go back into lockdown. The interesting point about this is that with a bit of discussion with our friends at CBR, we thought that we ought to see some sort of metastasizing of the crisis into the financial services industry, into the banking sector, and that would happen probably by an end to this extraordinary stock market rally that we've seen, which I think is probably primarily driven by the loose money policies that have been employed by central banks across the world. So something of a financial crisis, and also the start of a financial crisis led by the real estate sector, and in particular the way in which retail and hospitality are expected to show some very, very marked declines as the crisis brings forward the trends that the internet started 20 years ago towards fewer retail properties, fewer hospitality properties. And that creates a financial crisis because lending against real estate gets into trouble because real estate prices collapse. So that's a particularly cheerful scenario. What are the results of this work? Well, I think the thing that's most interesting, is that even in the central scenario, we see that GDP in the UK is not going to reach 2019 levels until 2024. So that is quite a shocker. And if you decrease the size of the economy by 11%, which is what the expectation is this year, even if you have a marked bounce back in 2021, and the central scenario that we've got here expects a 5% increase in GDP in 2021 and just under 3% in 2022, you're still fighting very hard to recover ground that you used to hold. So that, even the central scenario is quite a sobering thought, I think it's fair to say. Our upside scenario actually sees things return to 2020 levels much earlier. We see it in 2022, and that's because we only have a 9% fall this year, followed by a 10% rise in the economy in 2021. So in fact, we're right back where we started pretty quickly. I think most of us probably at this stage will believe that that's relatively unlikely to happen. The downside is rather more distressing. We see a second wave in the last part of this year, which leads to a nearly 20% fall in GDP, a further small fall in GDP next year, and only in 2022 do we start to recover ground. We only went out to 2026, but we weren't back at 2019 levels of GDP by that period of time. So sobering thoughts. And actually, in the latter scenario, we actually start to see quite high interest rates towards the back end of our forecast in 2025, 2026, because there's something of a sterling crisis. So it never rains, but it pours in that particular scenario. So just a few kind of final thoughts. This is going to be a different recession to many that we've seen in the past. And this really ought to be a restructuring recession. What we've seen is social distancing required by the coronavirus crisis, bringing forward a number of trends, but particularly trends due to digitization of the economy, and the ability that gives us as fundamentally social animals to interact with each other online. So because those trends have been brought forward, we should see a massive restructuring of the economy. You know, if you look at the recession after the GFC, the only part of the economy that I think fundamentally was restructured was the financial services economy. And I can't quite remember the precise numbers, but financial services was running at something like 10 to 12% of GDP in 2007, 2008. And I think it's running at something like 6 to 7% of GDP. So that bit of the economy was subject to fundamental change. And the fundamental changes came because A, it was fundamentally insolvent, but B, because of very aggressive government action to restructure that part of the economy. So that was a government-led process. The interesting thing is, will we see that kind of restructuring in other parts of the economy? The obvious areas are physical retail and the real estate industry. We're going to see, Chris talked about the way in which we'll see people moving to larger houses, perhaps slightly further out. But obviously, we'll see the centres of towns and cities very marked declines in the value of property in those locations. Lots of empty property and a need for the economy to restructure those bits of the real estate world in order to bring them back into use. And the mechanism by which that happens, of course, is a decline in capital values and rental values, which encourages people to find other ways in which to use those bits of property. But what's interesting to see is, will that restructuring be, when it's confronted with the big bazooka of government policy, loose monetary policy for the foreseeable future, perhaps continuing aggressive fiscal measures. I think it's interesting that in the industry that I work in, the leisure industry, there were quite a number of businesses that probably should have been restructured in the last recession, but continuing cheap availability of money, money in the form of something of an asset bubble, perhaps going into the private equity and allied communities, supporting businesses which perhaps were past their best and perhaps could have done with a more fundamental restructure. I'm not the greatest believer in before spring there must be a winter. I think there is a real role for government policy in order to protect us all from this sort of thing. But it'd be interesting to see whether that sort of fundamental restructuring does happen. And I suppose the other interesting area as regards government policy is, government policy when it meets reality. What will that look like? Clearly, the government did a lot starting in March. I was on a skiing weekend in Morzine when lockdown happened in France, and it was very impressive to see the way the French went about that. And there was no messing. The gendarmes came around, they closed the hotel, said, "You're going home, the hotel's closing," all the shops were closed, and it was done in a very dramatic fashion very quickly. And I found myself sitting in a transfer bus going to Geneva Airport to get on a deserted flight at a deserted airport, thinking that the hospitality industry in which I work is going to be very dramatically impacted by this. And it struck me that a pandemic was very much like an earthquake, and that therefore, if there was an earthquake, the government sponsors something. Well, it sponsors a reinsurance company, which effectively reinsures the insurance industry against earthquake risk. So the government steps in and it protects businesses against earthquakes. This feels more like an earthquake than perhaps a financial crisis. And I found myself writing a press release which got a certain amount of traction, saying that effectively the government should provide business continuity insurance to the whole of the economy in order to protect it from the impact of lockdown caused by the pandemic. What happened was that that week, Rishi Sunak got up and he unveiled his big bazooka. £300 billion, I think, was the number that was thrown around. Much of that, in the first instance, was in the form of loans. I think the coronavirus job retention scheme was very much along the lines of the insurance solution that I advocated at that point. I did think that loans were fundamentally the wrong way to go about supporting the economy through a crisis, although I do respect the fact that the government was faced with a very, very difficult crisis, and it did everything it could as quickly as it could to deal with it, and they were just trying stuff out, and I think more credit to them for doing that. But it's interesting that in the last few days there has been quite a lot of noise around the fact that these loans may well get restructured, and I think that's right. I don't think we'll see that those loan schemes will have achieved a great deal, because when businesses reopen with weakened balance sheets, even with loans guaranteed by the government, that's not what we need for a strong and vibrant economy, and the government is going to have to find a way to deal with that. So Andrew, that's me done. No slides.
Thank you, Peter.
Did I need them? I asked myself.
And thank you. Some really lots to think about there. And I suppose just reflecting on some of those thoughts around potentially the acceleration of some of the changes that we've all felt are coming, versus your closing point around balance sheets and how strong balance sheets may be sort of coming out of this first stage. Is now the time to be potentially aggressively investing in technology and really sort of reinventing your business as a technology-led remote professional services firm? I might pose that one to Colin initially, just for thoughts of what we're seeing in the sector.
I think it's all very interesting times, and I think one comment I know made the comment that law firms, for example, have moved forward 10 years in the last 3 months within their time span, and I think the acceptance that we all had these computer systems that in theory would work, the ability for firms to have actually set up shop and work remotely has been fantastic in the majority of cases, and that's enabled business to continue. And I think, as Peter's saying, I think the government's interventions with their effectively cash flowing business has been good. I think most firms have seen fairly good cash positions, which hopefully enables them to invest and think about what the business should look like coming out the other end. And I think there's been a huge drive towards technology, but I think pace of that has been substantially increased by the change. I don't, as Chris was saying, I don't envisage people going back to offices in the manner that they were used. There will be some people who will be 5 days a week in the office. A lot of people will be a mixture of working from home and from the office. But I think overall, I think there will be a massive change in technology, and those that adopt and embrace technology will benefit going forwards.
I mean, from my perspective in the M&A world, I was talking to my colleague who specialises in tech. The leisure M&A world is not particularly active at the moment, except as regards insolvency and restructuring work, as you might imagine. But the tech M&A world is back to normal, so deal volumes are untouched, and the bulk of deal volumes in tech in the UK are, quite sort of nuts and boltsy businesses that help other businesses deal with tech, so putting stuff in the cloud, IT services, implementing IT systems, and we all, as professional services firms, we all experience those businesses in our everyday lives because they support this kind of activity that we're doing at the moment. Those businesses have seen decent growth. There's a huge amount of money chasing after too few deals at the moment, So that whole world is absolutely trading as it always has, which I think is very interesting indeed. Very few bits of the economy are in that state at the moment, I think it's fair to say.
Chris, any thoughts?
So I think from a macro perspective, we know that in the aftermath of the financial crisis, the UK started to experience and has continued to experience a massive productivity shortfall relative to the kind of productivity growth that we saw before the financial crisis. Lots of potential reasons for that. Maybe the allocation of credit hasn't been right, or maybe businesses in the UK, and indeed relative to some other economies, have been relying more on relatively cheap flexible labor rather than investing in capital and high-tech capital in order to streamline their businesses and to improve productivity at a macro level. To the extent that economic crises are bad things, but to the extent that they can come with a degree of creative destruction and technological upgrading in the longer term, maybe that could be one of those silver linings that might help make me think that maybe the kind of productivity shortfall from this crisis perhaps maybe won't be quite so bad as the shortfall from the last crisis.
Chris, what did you think of the Office for National Statistics changing the pricing model, I think it was, for the telecoms industry, and adding, it appears, several points to GDP as a stroke? Was that something that appeals to you?
Yeah, I mean, I'm trying to recollect the exact nature of the change. It was a bit, I think I've had it a bit odd at the time, in terms of exactly how the measurement, really kind of reflected the improvement in welfare in the economy. I think it's something to do, isn't it, with kind of improving download speeds and broadband speeds, in the sense that
they thought basically the price of telecoms services had declined by 50%, and in fact they decided now to decline by 95%.
Okay.
Over the last 15 years, so it's quite dramatic.
It's the kind of sort of quality adjusted price.
Suggestion that it will cure our productivity problem as a stroke.
I mean, potentially statistically, I can kind of see where the ONS is coming from, even though, it's not necessarily GDP that you can see and feel in the way that you normally would. But often, I suppose, the way I think about, productivity or productivity shortfalls is I tend to think about them as kind of relative to some kind of a pre-crisis trend or something like that. And to the extent that methodological changes like that are a bit more of a kind of, they change the trend or they change the level of GDP, it doesn't necessarily change the kind of shortfalls relative to those sorts of levels. So I think when I'm thinking about those kind of broad sweep productivity dynamics, those things will shift the trends around a little bit. But in terms of the kind of cyclical dynamics, they don't necessarily would change my interpretation of the data all that much. But yes, ONS method changes and GDP are kind of funny old games, really, and you can see those changes from time to time that can help you reinterpret the past a bit.
And perhaps turning back to Brexit, we touched on it, but does Brexit potentially have the opportunity to be helpful in the current scenario? Does it have the opportunity for us to create a more nimble economy, perhaps to deal with some of the issues?
It's. I mean, often when you speak to an economist, they'll say, well, it's hard to see the kind of net upsides from Brexit because that, from an economic perspective, you're cutting yourself out from a large trading relationship. But having said that, yes, at a sort of sector level, perhaps you can think that to the extent that the UK comes up with a deal with the EU, whereby potentially you can have some divergence on level playing field rules, or, in the new world of state intervention, some sort of divergence from state intervention rules, which, I should also say actually have been suspended for the time being at an EU level. To the extent that the UK could carve out niches in those sorts of areas, you could see some, potential opportunities there at a sector level under a, potentially very new regulatory framework in the UK. But the macro challenges of Brexit are still very much there.
I mean, it's a good time to do a no-deal Brexit, isn't it? If you've got 15% fall of GDP anyway, you know, next year 1 or 2 points, who's going to notice?
I think that's probably framed some of the government's thinking in this, to be honest. Yeah, I mean, in terms of the potential impact of a very disorderly Brexit, perhaps it wouldn't be quite so kind of extreme as the kind of no-deal Brexit we were thinking, you know, pre-transition, given that, you know, there's been more time for planning to be done. We have a withdrawal agreement, which has a Northern Ireland protocol embodied within it, for example. So you have some of those sorts of things that could be managed better and more smoothly. But I think we're still thinking about, you know, economic disruption, fall in the pound, squeeze on real incomes through higher inflation, trade barriers between the UK and the EU. Those are still very much things that are within our thinking in terms of the risks to the UK. But yes, the marginal impact relative to 20% declines in output in April, it throws things into an interesting perspective.
And I think going down a slightly different route, prior to the pandemic, we saw that there was quite a bit of funds available for investment, and certainly in private equity funds, and with low interest rates likely to be potentially around for a while. Are we likely to see an increase potentially in corporate takeovers, distressed M&A? I don't know. Is there a deal-led recovery?
I've just been outbid by somebody on it's a well-publicised process, but I won't go into the details. But and this is a casual dining business that really desperately needs restructuring, and it's, when I think of a zombie business that's been kept alive by, you know, perhaps an asset bubble in private equity, or just this sheer volume of cheap money that's been available over the last decade. This particular business is the one I think of. And I've been trying to pluck out a bit of it with a private equity firm and its previous management team. We were outbid by somebody who wants to buy the whole thing, and the bank was in charge of the situation. You know, didn't want to break it up if they could avoid it, because obviously the hassle that's involved in that. I spoke to the guy who's outbid us, who I know quite well, and he's a very good chap. And he said, well, yeah, it's very hard to find things to invest in at the moment. And, you know, we've raised a load of money. And I know this business has burned up $750 million of capital over the last decade, and has seen off 3 of the largest private equity firms in the world, all of whom have lost every penny that they've invested in it. But I think I know how to fix it, and there's nothing else around to invest in at the moment. And I thought that kind of summed up, you know, the private equity bubble better than anything that I could. This guy is not a distressed investor; he's a good investor, and he knows the sector. So good luck to him. But you know, he's going into a pretty unfamiliar field, and he's buying a business that is shut. You know, buying a business that is shut is quite a brave thing to do, especially if you don't really know what's going to happen in terms of local lockdowns, a second wave, all that kind of stuff. So, you know, that's cheap money in action. You know, people being forced to put money into riskier activities, take it out of less risky activities. So, you know, perhaps it's working, but the downside is perhaps you get more zombie businesses as a result.
And I suppose in that context, do we see potentially professional services as you know, we've seen private equity putting a toe in the water with professional services for a few years. Do we see that as being a more attractive sector, and perhaps for people running those firms, is this a good way perhaps to look to manage some of the challenges over the next few years?
I mean, the corporatization of large swathes of the professional services sector happened in the 90s and the 2000s, you know, particularly real estate consultancy and other kind of real estate related businesses. Private equity's not really managed to get much of a foothold in the bits of the professional services industry that remain essentially partnership based. It'd be interesting to see whether, if they bring their rates of return down, which they may have to, whether that kind of money starts to become more attractive to successful professional services businesses that perhaps haven't seen the need for outside capital in the past.
I think the professional service sector is actually quite in a fascinating position, because clearly they need to invest for the future with technology and so on. So actually the need for funds is increasing. And I think that's driven some of the recent market activity. But equally, you get the position with DWF, which floated a year ago and has gone through a very difficult pandemic. And I think that has a negative influence on firms considering external capital. But nevertheless, I think there is a need to invest. And how do you invest in a partnership? It's by using partners' money. And therefore, I think there's a significant mismatch there, and people will look at options, and I think they'll continue to look at options. I think what's quite interesting about the Managing Partners Forum running survey during the course of the pandemic, and the professional service sector in the early stages of the pandemic, 56% of firms, so the majority of firms, were predicting a decrease in their income of 30 or more percent, which is pretty phenomenal figures. But that's now dwindled to this stage where they're actually saying the impact is going to be only 11%. Think it's going to be 30% or more. Interestingly, they're very much divided by between 20 and 10%, in 39% for 20% decline and 34% for 10% decline. And that's probably borne out by the conversations we're having with firms. I think a lot of firms are seeing a 15 to 20% drop in income. The danger with that is, whilst that's income, when you convert that to profit and profit margins, invariably that we're talking about a 30% in drop in partner profits. And if you are 30% drop in partner profits, partners are used to the cash coming out of the business. So that means the investment fund is disappearing again. So what is the solution? The solution may well be to look for some form of external capital. The environment of having private equity sitting on at your board table is a very different discipline to being just a group of partners. But I don't think it should be ruled out. I think there is, well, I understand there's a big surplus of funds with private equity and similar investors. And they're looking for places to invest. And certainly we've seen a couple of private equity firms in recent years invest minority stakes in professional service firms. And I think that may be an interesting avenue. It all depends on pricing and how much they interfere with the day-to-day running of the business and whether that's acceptable to the partner group.
Excellent. And conscious of time, I'd like to pose another question to the panel, which would be, I suppose, bearing in mind this black swan event that we've just been through, the potential for that to be around for a period of time, or for other such events to happen in the future. In as brief as you can, what should firms be doing now to increase their resilience, and where should they be investing, particularly the professional services sector as we can be?
Yeah, I suppose sort of related to my point on productivity, those sorts of things that increase high quality productive output, a shift towards teching up and being resilient to crises whereby people have to work from home more often, in a world potentially where where businesses have managed to benefit from relatively cheap labor over the last decade and a half or so. That's a trend that could be coming to an end. So it's really just a kind of general point about investing in technology and raising those UK productivity levels.
I couldn't agree more. It's all about tech. I think building resilience through high quality tech got to be the right thing to do. And I go back to my point about, is this a restructuring recession? Bits of the economy will change very dramatically, and you probably want to be on the side of those bits of the economy that are going to change in a positive direction. I do think my particular sector, hospitality, will come back. If you're a fan of Victorian novels like I am, the businesses that you recognise in Dickens or Trollope, they're the pubs and the restaurants. You don't really recognise the blacking factories. and the like, because they don't exist. But the pubs haven't gone away. I think it's a basic social need human beings to get together and have a drink. Certainly a need that I have anyway, and maybe a meal. And I think we'll see that come back. However, there will be it's going to change quite dramatically, and the parts of it that have grown too quickly in recent years will disappear.
Yeah, and I think on the professional service sector, I think now's the time. To hark back to our original slides, it's time to rethink your business model. There'll be parts of it that actually are fine, but there's other parts that maybe you can do it in a different way, in a more efficient way. The way you package your services, how those services are provided. However, I've lived through a few recessions, admittedly never a recession like this one. But at times of change and crisis, the one thing you know about professional service firms is everybody needs advisors. And actually, it's not a bad place to be. There may be some reappraisal and readjustment and realigning of people and the type of work you do. But invariably, people need advice. I think the professional service sector will come out of it in a reasonable shape. But we need a good economy as well.
Excellent. Well, on that note, Colin, I think I'll take that forward in terms of we're in the right place and the right profession to be for now. Thank you to all of our panelists. Thank you for your insights and some interesting thoughts. Well, certainly lots to think about going forwards. We will be taking a break, a little bit of a break over the summer in terms of some of our webinars, but we will have another one in September. And as shown on the screen now, do take a look at our Professional Services Hub for the latest insights and updates. Without further ado, thank you very much and have a wonderful day.